bringing you the latest in tax credit news, insight, and analysis. This is Tax Credit Tuesday with your host, Michael Novogradac.
Hello, I'm Michael Novogradac, and this is Tax Credit Tuesday. This is the February 25th, 2025 episode. Now, for this episode, my guest is my partner, Charlie Rhuda. Charlie's in our Boston office, and he is one of Novogradac's leading experts in all things local living tax credit related. And Charlie is back for the latest installment in our So You Want to Be a LIHTC Developer series. This is a series that we designed to help developers, investors, syndicators, and others learn more about financing affordable rental housing with tax credits. We do have a playlist of all of the previous episodes in this series. It's available on our YouTube channel. I will post a link to the playlist in today's show notes. Now, Charlie is here to discuss a tax credit financing approach that has seen much more popularity in recent years. It's something that we often have a session at one of our tax credit conferences on, and we've also wrote about it in the Journal of Tax Credits. And in case you're wondering what it is, it's using both 4% and 9% credits to finance adjacent affordable rental housing properties. It's a combined 4% and 9% transaction. And this is often referred to as sidecar financing. And I actually draw a distinction between sidecar financing and twinning. When I think of twinning, I think of making an equity investment and getting more than one tax credit on that investment. And you can think of a combined locally tax credit with historic tax credits where the same equity dollars get both historic tax credits and local living tax credits. You can also think of it when you're doing solar financing on affordable housing, where you're twinning the same equities, getting multiple credits as a way to generate higher equity dollars to make projects financially feasible. Whereas sidecar financing are two subsidy sources that are used next to each other. Now, doing a 4% and 9% sidecar financing transaction does add notable complexity to a transaction. So Charlie's here to discuss some of the reasons why this more complicated structure is gaining popularity, as well as he'll share some of his advice. And he spoke about the four major areas that if you are a developer and or investor in one of these transactions, you want to make sure that you're aware of so you avoid some traps for the unwary. Now, we can never cover everything in a podcast. This is not an exhaustive list. Don't try this at home. It's just a way of making you a little more aware of some of the critical parts. And as we always say, it's important that you use experienced tax professionals, both tax CPAs. Obviously, I'm biased towards Novogradac, as well as tax attorneys. You don't want to work with a tax CPA and or tax attorney that hasn't done one of these transactions before. You always want to work with someone who's done something like this in the past. So with that, there's a lot that I want to discuss with Charlie. So if you're ready, let's get started. Charlie, welcome back to Tax Credit Tuesday.
Thanks, Mike. Happy to be back.
It's great to have you here. I won't take much of your time. This is busy season, and I know you have February 28th deadlines. It's not a leap year, so you don't get that extra day. But I appreciate making time for this podcast. I think it's a very timely topic. But before I jump into that, please describe the services you provide to your Novogradac clients.
Sure. Thanks. So my practice is primarily focused on affordable housing transactions, right? And a lot of work with taxes and bonds. And so we provide a lot of help up front when the transactions are getting structured. There's some major compliance milestones that need to occur depending upon whether you're doing a 4% or a 9%. And we'll talk about the differences of those in a few moments. And then traditional audit and tax services during the operating life of the properties. And then some work at the end with structuring what to do when the property gets to the end of its tax credit compliance period. So sort of the whole gamut from start until rebirth.
So thank you for that. And I'm glad that you are available for the podcast because I always think of us at Novogradac, we work in niche areas.
Mm-hmm.
I love the tax credit. As big as it is definitely within the tax world considered a niche, but this is like a niche within a niche. Doing a 4 and 9, sort of sidecar financing transaction. But let's start with a really brief, this isn't a podcast about 4% credits and about 9% credits and cross comparing the two. We have other podcasts on that. You've been on here before to talk about that, but we'll link to those other podcasts in today's show notes. But if you could, just as a level set, explain the difference between 4% productivity bond credits versus 9% allocated credits.
Yep. So I like to talk about it this way. So the 4% credit is an as of right credit that you get for financing your project with private activity bonds, subject to meeting certain tests, like the 50% test, which has also been the subject of other podcasts. The 9% credit, it's called the allocated credit, because you actually go into the agency and ask for a specific amount of tax credits and you get a number. And that's the number of tax credits that you qualify for, assuming that you meet all your eligible basis, cost requirements, and lease up and your long-term housing occupancy percentage. And so really, so for the one, you're getting an allocation of bond authority, and for the other, you're actually getting an allocation of tax credits.
And just as a broader sort of explainer for the audience, when we talk about the 4% credit, we're talking about a project finance, as Charlie mentioned, with productivity bonds. And because they're financed with productivity bonds, there's a federal subsidy taint. So the credit percentage is lower. It's a 4% credit percentage. You can actually get an allocated credit of 4% as well. And that's if your cost of acquisition on an allocated credit is a lower rate of 4%, whereas new construction and rehab is 9%. And with that, let's jump into the sidecar transaction. So please explain, when I say a 4 and 9 sort of combined transaction with a sidecar structure, explain to the audience what I mean when I say sidecar structure, as best you think I mean it.
Yeah. So you have a project, and for whatever reason, you're going to have both 4% credits and 9% credits as funding sources. We can talk a little bit about why that would come up. So it could be two buildings next to each other. It could be one building, right? That's separated by condominiums. And so it's still two transactions because each one of those is going to be a separate taxpayer. You have a separate tax return, right? And so you're funding two things at the same time. So from a development perspective, you may be thinking about this as one great project, but from a financing perspective, you have to treat it as more than one transaction.
Right. It's as if, as opposed to having a 9% allocated credit transaction in one part of the city and a bond deal in the other part of the city, you basically have an existing sort of development. You break it up into these two different projects. And we're going to talk about, which is the focus of this episode, about the complexities and the various traps for the unwary. So if I'm a listener, one of the first questions going to my mind is, if it's more complicated, maybe you have to have a condo structure and the like, and you have to treat two separate projects and all the rest. Why is this a thing? Why don't I just pick one or the other?
Yeah, that's a great question. And that's a question that, people ask themselves, especially once they've gotten themselves into it and realize what they've gotten themselves into. So some states might have caps on the amount of credits that you can get for a 9% deal. So, maybe it's $1 million per project cap, and the project that you're proposing is going to need more than that level of subsidy. So you may be able to do a sidecar transaction, get a 9% allocation, and then also get a 4% allocation to help fund a larger project. That's one. Two is some states actually incentivize the winning of 9% allocations in order to get better utilization of their 4% private activity bond program. Virginia was an example of that, where they had excess bond volume cap allocations that they could be using for housing. And so in order to drive demand for that subsidy, they did the sidecar transaction, and it worked because they really aren't pushing that as much anymore because their 4% allocation is now being fully used. And then the third one is some states, for their 9% program, and you have to read their qualified allocation plan and see what their initiatives are, have deeper income targeting with the 9% credit. because it's a deeper subsidy, it can help support units at lower incomes, extremely low income, maybe formerly homeless. And so in order to be able to do, again, a larger transaction, right, you may need the 4%, you may be able to get 4% credits to finance maybe some of your higher income band units, because the 9% are going to be concentrated in your lower income bands. And the interesting thing about all of this is different parts of the country have different needs. And so you really need to understand what your state is looking for and what their expectations and initiatives are, because that may also help drive how you do this.
I thank you for sharing that. I'd toss another example in there. Some states you end up, when you compete for the 9% credit, you get extra points for lowering your request. And by doing that, you're more likely to win an award. So guess what? Developers do that. And as a consequence, you have this excess basis, and your project struggles to be financially feasible. And if a state has extra bond cap, you could then go and say, well, for this excess basis, I could conceptually carve out a separate transaction and use the bond cap to finance that excess basis to make the project financially feasible. So as the listeners can tell, all these various examples just reflect the fact that, as a general matter, if you get a 9% credit, you would go get the 9% credit, fund the project, and be done. Bonds just generally have a level of complexity to them, and they're not as steep a subsidy. But if you don't have enough 9% credit, then you want to go down the 4% route and supplement some of your 9% with the 4% is what ends up happening. And the flip side is, if states have underutilized 4%, they can get more housing built if they use the 9% as almost like a gap financing for the 4% bond deals. So those are some of the reasons why this concept exists. And then a listener might also be thinking, okay, I'm going to have a project that is combining both the 4% and the 9% as sidecars, as Mike Novogradac says, as sidecars. Why is this so complicated? And I mentioned with respect to the 4% bonds that the reason why a bond deal gets a 4% credit is because the basis is tainted by a federal subsidy, or by the tax and bonds, I should say. And that tax, by the fact that they're financed by these tax and bonds, means you get a lower credit percentage, a 4% credit. And back in 86, it was all done because they were saying, if I'm getting the tax advantage from the bonds, my credit rate should be lower. And then they ended up settling on the 4% rate initially, then a 3% present value, and all the rest. And to really go back in time, there was actually a question as to whether or not, if you finance the development with private activity bonds, but paid off the bonds before you place the property in service, does that taint still carry over? And the IRS ruled that it did carry over. So as a consequence, when you're combining the two subsidies into a single transaction, you have to be very focused on the bonds not tainting the basis, such that the 9% credit becomes a 4% credit. And that's all that we're going to talk about is about maintaining that separateness. So Charlie, when we prepared for the podcast, we came up with 4 kind of major, I don't know if it's traps for the unwary or issues around maintaining the separateness, so that the bonds don't taint the 4%, the productivity bonds don't taint the 9% credit, making it a 4% credit. And the first area, which isn't going to come as a surprise to anyone who's watching or listening, is maintaining the separateness of the transaction itself from a bookkeeping or documentation perspective. So please share with the audience the advice that you give to your developer clients about the steps they need to take or should be taking to maintain that separateness and that individuality of each of the two projects.
So it's important for the developer to remember that even though they're thinking about this as one project, it really has to be treated as two separate projects. And so that gets down to things like, getting 2 construction contracts, having 2 sets of development books, right? And doing everything as if you just happen to be developing 2 projects at the same time. And again, because they view it as one project, sometimes it can be difficult to remember that they need to maintain the separateness. So, it's the little things, it's the details that you need to do in order to make sure that you can continue to keep them separate so that there's no appearance. Again, you mentioned the taint, but it's so important. There's no appearance that any of the costs of the 9% project are being funded by any of your tax and bond proceeds.
Yeah, I think you had good advice. You have to change your view of the development into two separate projects. Everything within your system needs to view this as two separate projects. So when I think about, for our second area, when I think about these two separate projects, you get into an issue of common areas or amenities. And that particularly if it's condoed, if it's two separate buildings next to each other, you can still have certain common areas or amenities that, as a general matter, get included in the eligible basis. Explain some of the issues around amenities and common areas when you have two projects versus one project, and how you see it get treated or handled.
Right. So, most developments will have a management office, maybe some community space, right, and a number of other things. And so they're within your project and they're for the use of your residents, and they're supposed to be for the use of your residents. And again, in this case, because you've got two separate taxpayers, two separate projects going on, right, you can't have a sharing of a lot of those amenity spaces. And one of the examples is the property management office. So you've got people from both residents from both projects utilizing the same property management office. So it may be physically within one of the condominiums or one of the buildings, but because you don't have the exclusive use for the residents, you may not be able to include that in eligible basis. So that's sort of, if you're thinking about more than one building. If you're thinking about two condos in the same structure, in the same tower, so maybe you have a 20-story tower that has your sidecar 4% and 9%, you're going to have one lobby, you're going to have one set of elevator banks, right? And your units may be spread throughout the building. Those costs will get allocated to each of the projects based upon some, and we'll talk about cost allocations a little bit more later, but things like the management office and the community room, because they don't have exclusive use, are going to probably be excluded from your eligible basis.
And I think the sort of foundational rule that you're focusing on there is to be for a common area or amenity has to be included in eligible basis. It needs to be exclusive for the use of the residents, as well as there can't be any added additional charge for those two. And the additional charge is easy to deal with. It's the exclusive use rule that makes it a little bit more challenging in terms of which of those areas, in the individual, either side of the project going to have exclusive use of. And we will go into the whole issue around exclusive use because exclusive use at pools and such can be interesting question. But you did mention cost allocations, and that was the third area that we kind of had talked about and identified as an area where there has to be hypersensitivity, and that's how the costs are getting allocated to the two projects. So what advice do you give developer clients on that question?
Right. So you need to look at what your scope is for your project, because, it can be easiest to say, well, we'll just use straight number of units in each project or straight square footage in each project to be able to allocate the cost. But you may have some costs that are exclusive to one project or to the other. So say, for example, you've got a tower with an elevator surrounded by townhouses, right? And so the tower is say you're 4 and the townhouses are your 9, the elevator is going to get allocated exclusively to the tower, right? And your 4% transaction, right? And so, when we talk about doing cost allocations, in a perfect world, and most general contractors would do this, you can get separate scope, maybe 2 contracts, but certainly separate scope of services and of work that can be done in order to help keep the costs separate for your 2 projects. But other costs like permits and maybe even some of the professionals like architects and engineers may only give you one bill, right? And then in which case you're going to need to figure out what is a reasonable method to allocate those costs between your 2 projects. And that could be square footage or number of units, as I mentioned. or for some costs, it could be the relative cost. So if one project is bigger than the other, say twice as big, you may choose to allocate your costs based upon the aggregate expenditures for each project. So it's really something that we talk a lot about up front, because in the planning stage, as you're trying to determine how you're going to finance both projects, how much tax credits you're going to be eligible for in both of those. It's really important to have these conversations up front about how you're going to divide costs between the two.
And I'm glad you focused on having this discussion up front, because part of the cost allocation services that you provide to clients is helping them define the two projects.
Right.
Because on the 9% side, once you have enough eligible basis to use all your credits, any additional eligible basis, it doesn't bring you more equity. And then on the bond side, as you have more eligible basis, you have more equity coming in with the limit of the 50% finance buy test. You can't have so much basis that you end up not qualifying for credits on the entire development. So it's something that is pretty mission critical. I know you end up doing a lot of work with clients, doing those runs as they're trying to figure out how to define their project to maximize their resources to make it project financially feasible. So the fourth area that we have identified in terms of potential trap familiarity has to do with the actual tracking of funding sources to uses. So this is something that, I know you talk to clients about, so please share with the audience advice you have in the proper tracking of funding sources to the proper uses.
I'm going to start by, for the third or fourth time, mentioning the taint. It's so important.
Yes, it is.
That private activity bonds are funding the 4% transaction and not spilling over into the 9% transaction. So that's sort of the first thing to throw out there. A lot of funding sources, right? So normally you're going to have your local housing tax credits, right? You're going to have a mortgage, and oftentimes you're going to have supplementary funding, sub debt financing, right? Other kinds of subsidy programs. And those subsidy programs oftentimes come with limitations on what they can be used for. So for example, maybe you can't fund land out of one of the sources. And so you have to be careful about how that funding source is used. Some funding sources have income targeting baked in with them. So if you're doing the average income set aside with units potentially up to 80% AMI, you may need to be careful about utilizing a source that is maybe only available for extremely low or formerly homeless, right? And so that may be in your 9% transaction, right? And so you have to make sure that financing is sort of sticky to that transaction, where, other sources may not have some of those restrictions. And so as you're separating your transaction and doing your underwriting, right, you probably can start with some of the sources that may be, and I'll use the word sticky again, and then you'll have other sources that are more fungible and that you can sort of spread between the two projects based upon the needs and the other financing sources. Because in the end, you're going to have equity, you're going to have a first mortgage, and then you're going to have some level of subsidy financing. And so you need to be able to make sure that you line those up, because they each one of the projects needs to be self-funding, separately balanced, and separately financed. And so it's important to make sure as you're setting it up and then as you're drawing your funds down, that you're respecting that.
Great. Thank you for that, Charlie. I know there's a lot more that we could talk about here, not the least of which is all the documentation that the attorneys pull together to ensure there's the separateness. I will include your contact information in today's show notes for members of our audience that want to reach out to you. But before we bring this to a close, anything else you want to share with the audience?
Just, I actually had a meeting this morning with a client who was going to be doing a 4 and a 9. And we talked often about, the ounce of preventing a pound of cure, and how important it is to think about as many of these things as you can up front, how to plan for it up front, and how to get these set up in the mindset that it's two separate transactions, and then execute on that can be so much better than getting to the end and realizing, oh my, I should have been doing something differently, and then trying to go back and fix it afterwards.
Great. Thank you for that. And I would also note to our audience, the Locally Attachment Working Group will discuss this topic periodically. And we do have a conference coming up in San Francisco, May 8th and 9th. And this topic may be one of the conference sessions. So in the process of scheduling it out. So I don't know for certain yet if it will be on the agenda. And if you think it should be on the agenda, send an email to cpas@novogo.com and maybe we'll include it based upon your pointing out the importance of having a conference session on that. Before we get to the off mic section, though, I do want to remind the audience to subscribe to our podcast on whatever platform you prefer. And also, please do share the podcast with your colleagues you think may find the podcast of use. And we do have a full archive of all of the podcast episodes on our website at novoco.com. Now I'd like to turn to the off mic section. And this is where we give our guest an opportunity to give a shout out to someone working in one of the community development areas that we work. So it gives my guest an opportunity to highlight a professional worthy of such recognition. So Charlie, who would you like to give a shout out to?
I would like to give a shout out to Kathy Rubin, who's the Senior VP at WPP Development, Wild Baltic Partners Development in the New York area. I've worked with Kathy for many, many years. She has a great passion for affordable housing. She has a great knack for understanding the complexities and putting together transactions that have a great amount of community impact by bringing together a whole host of sources, subsidies, and people and parties in order to be able to execute on these transactions, whether it's new construction, whether it's a rehabilitation of a former Y. She does a remarkable job of being able to put all of this together in order to make something wonderful in the end for the residents.
Great. Thank you for that shout out. Let me echo that shout out, Kathy. Thanks for all that you do to provide affordable housing to more Americans. So Charlie, thank you for being on the podcast today. I will ask you, how many of your clients that have done a 4%, 9% sidecar once have elected to do it more than once?
So that's sort of a mix. I have some that have only done one. At the meeting I went to this morning, they're doing their third. And then I've had others who said, please don't make me do that. So I think it gets back to, again, what is it that you're trying to accomplish and what do you need to do to be able to make it happen? And so, yeah, you go through it, you get a lot of experience, and hopefully you can leverage that experience on the next one and make it go a little bit more smoothly.
Great. So thank you for that, Charlie. And to our audience, I'm Michael Novogradac. Thanks for listening.
This weekly podcast has been brought to you by Novogradac and Company, LLP. Archived podcasts are available online at www.novoco.com/podcast or by subscribing to the Tax Credit Tuesday podcast in iTunes, Spotify, YouTube, Google Podcasts, Stitcher, and Radio Public. You can find related links referenced in this podcast on our website at www.novoco.com/podcast. Novogradac and Company, LLP is a national certified public accounting and consulting firm with offices nationwide. Learn more about our professional services at www.novoco.com.